Hi everyone, welcome to my channel. If you have asked yourself, can I deduct my inventory when I purchase it? This video is for you. Before TCJA, Tax Cuts and Jobs Act, the answer would have been no. But TCJA introduced some language that can be interpreted otherwise. Let's start by asking, what is inventory? Inventory is the goods and products that a business owns to sell to customers in the ordinary course of business. It makes no difference whether you manufacture the goods yourself or buy finished goods from others and resell them to customers. Inventory includes not only finished merchandise, but also work in progress, as well as the raw materials that will become part of the finished merchandise. As long as you hold Title II, that is, things you own, constitute inventory. It also includes items you haven't yet received or paid for as long as you own them. However, goods that you hold on consignment are not part of your inventory because you don't own them. Before 2018, you were not allowed to deduct inventory costs in the same way you deduct other costs of doing business, such as your office rent or employee salaries. Instead, you had to maintain inventory on your books and deduct it only in the year it was sold, which could be long after it was purchased. So if you averaged more than $5 million in gross receipts over the prior 3 years, you were required to file your taxes as an accrual basis taxpayer. And if you were an inventory-based business, that threshold dropped down to $1 million. This inventory tax was quite a challenge for e-commerce sellers. In short, inventory-based business had a constant need for replenishing its stock reserves, which could mean a huge cash outflow. And it did not reduce your tax liability when you bought it. This may feel like you were in a perpetual cash flow crunch, not to mention super irritated when paying your taxes. But it seems TCJA unintentionally changed the long-standing rule for smaller businesses. If the average annual gross receipts earned by your business over the past 3 years total less than $25 million, you now have two alternative ways to treat inventory. You can treat it as non-incidental materials and supplies, or the same way it was treated in your financial statements or books and records. If the average annual gross receipts earned by your business over the past 3 years total less than $25 million, you now have two alternative ways to treat inventory. You can treat inventory as non-incidental materials and supplies. You must deduct these items the later of the year they are provided as finished goods to customers or the year they are paid for. Since most businesses pay for their goods or merchandise before selling them, they usually have to wait until the goods are sold to deduct their inventory as non-incidental materials and supplies. So using this method to deduct your inventory provides no great advantages other than some simpler record keeping. Also, the Uniform Capitalization Rules, Section 263 Cap A or UNICAP, which require that the portion of overhead and other indirect costs be apportioned to inventory, do not apply. Or you can treat it the same way it is treated in your financial statements or books and records. In other words, you may deduct inventory in accordance with your financial statement. An applicable financial statement is something larger businesses have and includes audited financial statements and annual filings with the SEC. Since smaller businesses don't have such statements, they may deduct inventory the same way it is treated in their books and records. We first need to make the distinction between a cash basis business and an accrual basis business. As you may know, if you're using the accrual method of accounting, you have to record your income and expenses when each are earned or incurred, regardless of when cash came in or went out. So if you have accounts payable or accounts receivable, you probably have an accrual-based business. So as an example, if you had a CPA do work for you in December, but you pay the bill in January, you get the deduction in December even before you spent the money. And vice versa, if you sold products to customers in December, but they didn't pay you until January, you'd have to include that income before you received any cash. So if you're unfortunate to have slow-paying customers, it's possible you'd have to pay your taxes before you even receive the money on the sale. The cash basis, on the other hand, would include income when you get paid and include expenses when you pay someone. So it's simple to understand that you would only pay tax on money you have actually received. Note, you may keep your financial records on the accrual basis for managing your business, but file using the cash basis for tax purposes. A CPA is able to make the appropriate adjustments for you. Now, here's what makes this provision quite interesting. It seems all businesses with less than $25 million in gross receipts are now allowed to use the cash method of accounting. Those that do so use this method in their financial statements and books and records. As mentioned earlier, with the cash method of accounting, income is reported when cash is received, and expenses are reported when cash is paid. Thus, inventory is expensed on a business's books when it is purchased. A sale or income is shown on the books when purchased inventory is sold and cash received. There is no need to calculate cost of goods sold at the end of the year, and the unit cap do not apply. In other words, smaller businesses that use the cash method can deduct all their inventory in the year it is purchased instead of waiting until it is sold. This is a huge change in the tax law. It benefits taxpayers so much that I don't think this was actually intended by Congress when it wrote the Tax Cuts and Jobs Act. And to take advantage of this provision, it may be necessary for businesses to file IRS Form 3115, Application for Change in Accounting Method, which would be automatically accepted by the IRS. The form would have to be filed by the due date of the business's tax return for the year, plus extensions. My advice is that I would tread carefully when coming up with your own wild interpretations of the rules, since historically, the IRS had been clear that inventory cost should match up with its related income. It's not a bad idea to continue using the accrual method for inventory. This will give you the best insights into how your business is performing, which should be more valuable than the amount of time you might save by accounting for inventory according on a cash basis. Now, if you decided to maintain an inventory, then deduct the cost of inventory only as it is sold. You must carry unsold inventory items as an asset on your books. You can deduct the cost of these items only when they're sold or become worthless as a business loss. And each year, you must calculate how much you spent on inventory and how much of it you sold to determine the cost of goods sold on your tax return. There is no single way to do this. Standard methods for tracking inventory vary according to the type and size of business involved. As long as your inventory methods are consistent from year to year, the IRS doesn't care which method you use. And you must report the cost of goods sold on your tax return using the following formula. Inventory at beginning of year plus purchases or additions during the year equals cost of goods available for sale minus inventory at end of year equals cost of goods sold. And if you are a sole proprietor or the owner of a single member LLC, the amount goes directly on your Schedule C, which tracks the formula just mentioned. Multi-member LLC or partnerships report their cost of goods sold on Schedule A of IRS Form 1065. S corporations report cost of goods sold on Schedule A of Form 1120S. And lastly, C corporations report this information on Schedule A of Form 1120. Well, whether you have nerves of steel or not, I hope this video was helpful clearing up this new inventory ambiguity. So with that said, thank you for watching, and if you haven't already, please subscribe and give this video a thumbs up.